Kunal Shah, Head Commodity Research at Nirmal Bang Securities, joining in this morning. Kunal, very good morning to you. I think the simple question is that will this trend continue?
There are shortages, so the possibility of sharp crash is very less. But you should still remain invested in precious metals, but you should lower down your return expectation. That is the key message at the start of the show I will give before we head into the main discussion. So gold and silver likely to still remain core assets going forward. And looking at the way the supply side has not responded sharply, even after the humongous rise in prices, what we've seen during the year. So my sense is that from here, another 50%, 75% upside, very difficult. So both commodities are still capable to give you better returns than the fixed income products or even perhaps other asset class. So 10 to 15% conservative returns is the base case scenario right now. And I still believe that you should remain invested in precious metals.
Kunal, good morning. Hiral on this side. Okay, so you're saying 10 to 15%. Is this for gold and silver or for any one of the precious metals? Because when we were looking at the consensus, we're looking at a 10 to 14% upside for gold, whereas silver is indicating a negative of around 6 to 19% on a consensus basis for 2026.
Okay, so right now I'd like to explain you before I give you the answer of this question. The new demand, I mean, we've not seen this kind of demand in precious metal. The new demand, so like data center, this was not existent 4 years back. Now you're talking about in gold. The companies like Tether, okay, they are basically a crypto-based, gold-based crypto. So the holding of this company is 112 metric tons of gold. I mean, we've never seen this kind of demand. If you see the countries holding 100 tons, 200 tons, and the cryptocurrencies companies are having a holding of gold at 112 metric tons, that's quite humongous. So this is new demand. Everyone is afraid of the monetary crisis which can come. You saw what had happened in Japan. After the interest rate hike in Japan, the bond yields shoot up. There was a sell-off in bond market. Whenever there is a rise in interest rate, the inflationary expectation generally comes down. So in spite of the fact they hike the rate, the market is not ready to believe that inflation is not going to come down. Inflation on a long-term basis is going to shoot because central banks are printing money like there's no tomorrow, direct or indirect form. So right now, even if you look at Fed, through the reverse repo operation, they are infusing a lot of liquidity into the financial market. So how the inflation is going to go down in the western part of the world, and if that is the case, what is your hedge? So everyone has realized that suddenly, and the investment demand of gold has skyrocketed over last 3 to 4 months. Everyone is rushing towards buying safety, buying like a insurance policy against the risk which can arise due to the imprudent monetary policy decision by the global central bankers. So I believe that gold is better placed right now to give you 15 to 20% return. Silver, there can be a sharp profit taking because we've seen a humongous rally. There can be a sharp profit taking also. So silver, I would recommend you to wait, and then whenever there is a profit taking correction, at that time you can indulge into a fresh long position. But gold, I feel that should outperform going forward, and 15 to 20% return conservatively is something what you expect from gold in next 1.5 years. So I'm more optimistic towards the outlook of gold rather than on silver at these levels.
Kunal, you may be a little biased here because, the commodities is something that you see so closely. But gold versus silver versus equity. At the start of the new year, if someone wanted to put their investments together and decide their allocations, what would you say?
See, considering this year's return, everyone will be saying that this year is a quite exception year. I've been in this market from 20 years. I've never seen gold delivering 65% return and silver delivering you this kind of return. So I think this was exceptional year. So that's the reason I'm saying, people didn't realize that gold is a great buy at $3,000. Now at $4,600, you are suddenly putting a lot of wealth allocation to gold. I think that's not right. So at this level, I would say your your allocation towards gold should, whatever you invested should remain in gold, but fresh allocation at these levels, aggressive, no, that's not what my base case scenario, because you don't know what are the reasons which can cause profit taking or correction. And I think those are the times you start re-entering into long position. Not an aggressive long position should be made at these levels. That is my clear message to the investors.
No aggressive long positions at these levels. What, in your view, is the best way if someone doesn't have gold exposure at all? What is the best way to now get in, and in what timeline?
Yeah, so I would say you can buy it in a staggered way. So, for example, if you're buying at $4,500, you should be ready to buy more at $4,200. That's the best way to approach. And the better products right now in the markets is gold ETF. I think they are the fantastic products to invest in gold. Whoever has invested in gold ETFs have been rewarded handsomely. And if you look at the overall expense ratio and everything, I mean, the cost is very minuscule. So gold ETFs are the best way to invest in gold, and you should invest in a staggered way. Gold will continue to be a very important asset in this kind of environment where there is an expectation of sharp monetary debasement which can take place. There can be a sharp volatility in the market, financial market, due to abrupt rise in the bond yields, and central bank is going to print a lot of money to bring down those yields. So in this kind of scenario, you should remain in gold, but I mean, don't have that exorbitant target. It is not wise to have that exorbitant target after gold has delivered you the 65% return. Lower your return expectation and stay invested.
I think the average return expectation for the Nifty is low double digit.
Double digit, yes.
Low double digit. So I think after 65%, gold might do at least better than that. But having said that, a balanced portfolio is what you should always have, and that ground rule doesn't change. Kunal, thank you so much for joining us this morning on India Market Open. Pleasure to have you on and have your views in that there is more legs to the rally when it comes to gold and to silver, because there are shortages which are there, but perhaps not the kind of astonishing returns you've seen in this last year. I mean, 65% in 1 year is something that has never been seen.